Something is happening right now that is rewriting the rules of the global financial system. A titan is shifting its weight, and the impact will be felt by every investor on the planet. JP Morgan, the bank that spent a decade at war with Bitcoin, has just handed it the keys to the kingdom. This isn't just news, it's a trillion-dollar roadmap to the future of money. Eye-watering price targets that signal to their thousands of institutional clients where the smart money is heading next. We're talking about JP Morgan, the bank whose CEO, Jamie Dimon, famously called Bitcoin a fraud and compared it to tulip bulbs.
Bitcoin itself is a hyped-up fraud. It's a pet rock.
You're back to that?
Yeah,
Really?
Of course, yeah.
Well, his own bank's strategists are now making the mathematical case. They are arguing that Bitcoin isn't just competing with gold, but fundamentally outperforming it on a risk-adjusted basis. Their long-term theoretical price target, a staggering $266,000 per coin. This isn't a wild guess from a crypto influencer. This is cold, hard analysis from the heart of Wall Street, mentioned in reports as recently as February 2026. So, what changed? What does JP Morgan see that others are missing? We're going to break down their shocking analysis, what this pivot truly means, and how their new target could reshape the entire financial landscape. This is the story of how the ultimate Bitcoin skeptic is now providing the roadmap for its biggest rally yet. All right, let's cut right to the chase. What exactly is JP Morgan saying? In a series of detailed reports, their global market strategy team, led by Managing Director Nikolaos Panagirtsoglou, has fundamentally altered its thesis on Bitcoin. For years, the financial world operated on a simple premise. Gold is the ultimate safe haven asset, the bedrock of a portfolio during a crisis, and Bitcoin is the volatile, high-risk tech play. JP Morgan's new analysis throws that entire framework out the window. The core of their argument is a concept they call a volatility-adjusted comparison. For the first time, their models show that Bitcoin is becoming quantifiably less risky relative to gold. This is a monumental statement. They argue that as gold's own volatility has been increasing due to geopolitical tensions and massive central bank buying, Bitcoin's volatility has been steadily decreasing. Bitcoin is maturing as the asset matures and institutional money flows in. This convergence has reached a tipping point. According to their research from early 2026, the Bitcoin to gold volatility ratio has plummeted to a record low, sitting at approximately 1.5. This means Bitcoin is no longer the chaotic, unpredictable asset it once was in the eyes of institutional risk managers. It's maturing, stabilizing, and becoming a credible alternative. It is becoming a credible alternative to the 5,000-year-old store of value. And this isn't just a theoretical observation. The report outlines a direct challenge to gold's dominance. The analysts at JP Morgan are essentially telling their clients, pension funds, hedge funds, and sovereign wealth funds, that if you are holding gold for safety, you must now look at Bitcoin through a new lens. They've stopped seeing it as a speculative gamble and started modeling it as a strategic portfolio allocation, a direct competitor for the trillions of dollars currently parked in gold. This shift is the us versus them narrative playing out in real time. For years, it was retail investors and early adopters who saw the vision. We were told by the financial elite that it was a bubble. Now, the largest and most influential bank in the world is not only agreeing with the fundamental thesis, but is putting out the mathematical framework to justify it. They aren't just joining the party, they're trying to host it. The implications of this are staggering, and it signals that the next phase of Bitcoin's adoption is being architected from within the very walls of the system that once sought to discredit it. To get the sheer magnitude of this, you have to understand who JP Morgan is. This isn't just any bank. JP Morgan Chase is a global financial colossus with a balance sheet approaching $4 trillion. They have an asset management arm that oversees trillions more in client funds. When they speak, the entire financial world listens. Their research reports don't just offer opinions. They set institutional mandates that guide hundreds of billions of dollars in capital allocation decisions. Now, let's add some context. This is the same institution whose CEO, Jamie Dimon, has been one of Bitcoin's most vocal critics. In 2017, he famously threatened to fire any trader at his bank for trading Bitcoin, calling it a fraud and worse than tulip bulbs. He has repeatedly dismissed it as a decentralized Ponzi scheme. His disdain for the asset is legendary. He has been the face of Wall Street's skepticism, and that is precisely what makes this new analysis so earth-shattering. It represents a deep internal schism between the bank's public-facing figurehead and its own elite strategists who are running the numbers. While Dimon may still hold his personal opinions, his own analysts are now directly contradicting him. They are looking at the data, the inflows, the volatility metrics, the adoption curves, and have come to an undeniable conclusion. Capital is flowing into this new asset class, whether the old guard likes it or not. This isn't just an analyst upgrading a stock. This is a philosophical capitulation. It's an admission that the narrative has fundamentally shifted. For years, the argument was that it lacked a valuation model. Well, JP Morgan just built that model. They've created the intellectual and mathematical bridge for other conservative, risk-averse institutions to cross. They've provided the justification. They've provided the cover that a fund manager needs to present to their investment committee to justify an allocation to Bitcoin. They've taken the argument away from the rebellious world of crypto. They have placed it squarely into the language of institutional finance, risk parity, volatility adjustments, and portfolio optimization. Think about what this means. The bank that was the poster child for anti-Bitcoin sentiment is now publishing this research. This research could unlock a floodgate of institutional capital, putting a giant flashing price target of $266,000 to show them the potential reward. This is the sound of the dam beginning to break. So, how on earth does a famously conservative bank like JP Morgan arrive at a price target of $266,000 for Bitcoin? This number sounds like something you'd hear on Twitter, not from Wall Street quants. The answer lies in a sophisticated valuation method that completely reframes Bitcoin's worth. Let's break it down, because this is the engine of their entire thesis. The foundation is a simple question. What if Bitcoin were to achieve the same status as gold in private investor portfolios? First, they quantify the size of the gold market held for investment purposes, bars, coins, and ETFs. They exclude gold held by central banks. Their estimate for this slice of the market is enormous, approximately $6 to $8 trillion. Now, a simple approach would be to just match market caps. But that's not what JP Morgan did. They knew that would be an irresponsible comparison because $1 in Bitcoin isn't the same as $1 in gold from a risk perspective. This is where the power of their model comes in. The key insight is that Bitcoin has historically been much more volatile than gold. An investor looking to take on the same amount of risk would need to allocate far less capital to Bitcoin. For years, this gap made it difficult. But JP Morgan's analysts spotted a historic convergence. They calculated that the current Bitcoin to gold volatility ratio has collapsed to a record low of about 1.5, meaning Bitcoin is only about 1.5 times more volatile. Other recent analyses from the bank have placed this risk-capital consumption ratio at 1.8. This single number is the linchpin of their entire argument. It allows them to compare the two assets on an apples-to-apples risk basis. So let's run their math. They take the total private gold investment market, that multi-trillion-dollar figure, and they adjust it for this new volatility ratio. Instead of a dollar-for-dollar match, they use risk parity. If Bitcoin is 1.5 times as volatile, then to have the same risk weighting in a global portfolio, its market cap should be about 67% of gold's. Take that $8 trillion estimate and divide it by the ratio of 1.5. That gives you a theoretical, risk-adjusted market cap for Bitcoin of approximately $533 trillion. Divide that by the circulating supply, and you get a price of approximately $270,000 per coin. This is how they arrive at their headline-grabbing $266,000 long-term target. It's not a guess, it's the output of a formula. Now, it is absolutely critical to understand how JP Morgan frames this. They are explicit that this target is not a prediction for this year, even calling it unrealistic in the near term. They see it as a long-term theoretical valuation that represents the upside potential. It represents upside if Bitcoin's volatility continues to converge with gold's and investors fully embrace it as a legitimate macro hedge. But the message is what's important, a roadmap for valuing Bitcoin. JP Morgan's seismic pivot on Bitcoin didn't happen in a vacuum. A bank this size is like a massive battleship. It takes a tremendous amount of force to get it to turn. This analysis isn't the cause, it's the result. It's a reaction to an underlying current of institutional adoption that has become too big to ignore. The first and most obvious catalyst was the launch of spot Bitcoin ETFs in early 2024. This was arguably the single most important structural development in Bitcoin's history. Suddenly, any pension fund, endowment, or asset manager could buy Bitcoin as easily as buying a share of Apple. The success of these ETFs has been breathtaking. As of early April 2026, reports show that U.S. spot Bitcoin ETFs have pulled in over $53 billion in total inflows, with assets climbing past $86 billion. This isn't retail FOMO. This is a steady, systematic flood of institutional capital. And where is some of that capital coming from? You guessed it, gold. For the first time, we are seeing a clear rotation. While Bitcoin ETFs have been swallowing billions in new assets, gold ETFs have experienced significant outflows. To an analyst at a place like JP Morgan, this is a five-alarm fire. They are witnessing, in real time, the beginning of what could be a multi-trillion-dollar reallocation between the analog and digital stores of value. But it goes deeper than just ETFs. The entire ecosystem has professionalized. We have publicly traded mining companies, sophisticated derivatives markets, and now even major Wall Street banks like Morgan Stanley are launching their own Bitcoin ETFs. This is the infrastructure that fiduciaries need. These are people legally obligated to manage other people's money responsibly. That infrastructure is now firmly in place. JP Morgan's analysts are not creating this trend. They are simply observing it. They see the ETF flows, they see the outflows from gold, and they understand that a paradigm shift is underway. Their analysis is their attempt to get ahead of it and to guide their clients. The evidence has become irrefutable. The institutional herd is on the move, and JP Morgan has decided it's better to lead it than to be trampled by it. Let's take a quick pause. We have JP Morgan, historically Wall Street's biggest Bitcoin skeptic, now providing the intellectual framework for a massive price increase. Their CEO called it a fraud, but their analysts are building models that compare it to gold. That math points to a potential long-term price of $266,000 per coin. And it's all happening because the institutional money is finally here, pouring billions into the new Bitcoin ETFs. This is the what and the why. But what does this mean for the price right now? What are the risks, and what does this all mean for you? Before we get into that, if you're getting value from this breakdown, do me a huge favor. If this breakdown is helping you navigate these massive shifts, take a second to hit like and subscribe. It keeps you ahead of the curve and ensures you never miss our next institutional analysis. Now let's get back to the downside risks. Now let's get into the downside. While a $266,000 price target grabs all the headlines, what truly separates institutional analysis is a deep focus on risk management. JP Morgan's report isn't just a bullish fantasy. It also provides a framework for thinking about Bitcoin's price floor. And to do that, they look at one of the most unique aspects of the network, the cost of production. This is unlike other assets. Bitcoin has a quantifiable, real-world, electricity-driven cost to create it. This is the work done by miners. They invest billions in hardware and energy to secure the network. For their business to be viable, the price of Bitcoin has to be higher than their cost to produce it. This production cost therefore acts as a soft, floating price floor for the entire market. JP Morgan's analysts have a model to estimate this. In early 2026 reports, they estimated the all-in cost to produce one Bitcoin had fallen to around $77,000. This number changes based on the hash rate. Here's where it gets interesting. When Bitcoin's price falls below this production cost, a self-correcting mechanism kicks in known as miner capitulation. The least efficient miners are forced to shut down. When they go offline, the network's total hash rate drops. The Bitcoin protocol is designed for this. Roughly every 2 weeks, it automatically adjusts the difficulty to keep block time steady. A lower hash rate leads to a lower difficulty. This means remaining, more efficient miners can produce the same Bitcoin with less energy, which lowers the average cost. A new lower price floor is established. We saw this play out in early 2026 when winter storms in Texas knocked miners offline, leading to a hash rate drop and a subsequent downward difficulty adjustment. So when JP Morgan sees a dip, they don't see a crisis. They see a predictable market cycle playing out. It's a sign that the market is finding a bottom. It gives them a tangible, data-driven level to analyze downside risk. Institutions see a system designed to be anti-fragile. So, we've gone through the bombshell analysis, the math behind the target, and the dynamics of the price floor. What does this actually mean for you, the individual investor? First, let me be absolutely clear. Nothing in this video is financial advice. My goal is to decode what the world's most powerful financial institutions are thinking, so you can make more informed decisions. The single most important takeaway is validation. For a decade, the biggest risk for Bitcoin was that it would never be accepted by mainstream finance. That risk is rapidly diminishing. When the biggest bank on Wall Street publishes this, it sends a signal. The debate is no longer about if Bitcoin will be part of the financial system. It's about how big a part it will play. This leads to the concept of the asymmetric bet. This is an investment with huge potential. Your downside is limited to your initial investment, but the upside, as JP Morgan's model suggests, could be multiples of its current price. Their analysis provides a logical framework for this asymmetry. By valuing Bitcoin against the multi-trillion-dollar gold market, they are suggesting Bitcoin isn't just another tech stock. They are framing it as a potential global store of value in the very early innings. Even a small reallocation of the capital in gold would have a massive impact on Bitcoin's price due to its fixed supply. This directly addresses the biggest anxiety for investors. Is it too late? According to the institutional framework from JP Morgan, we are just at the beginning of the main event. The first chapter of Bitcoin was about survival. This new chapter is about institutional adoption. The tens of billions that have flowed into ETFs are just a drop in the bucket compared to the trillions managed by funds who are only now getting the green light to begin their allocations. So, for you, this means viewing it strategically. It means understanding that the world's smartest money is no longer laughing at Bitcoin. They're building mathematical models to buy it. So where does this all leave us? We've witnessed a historic pivot. JP Morgan, the symbol of Wall Street's old guard, has laid out a clear, mathematical roadmap for a $266,000 Bitcoin. This isn't just another price prediction. It's a fundamental shift in how the world views this asset. The revelation is that the game is no longer Bitcoin versus a skeptical financial system. The game is now Bitcoin versus gold. JP Morgan's analysis has provided the justification for treating it as a legitimate store of value. They have moved it from the category of speculative tech to strategic hedge. The great institutional reallocation has begun. The trillions in traditional assets are now looking at Bitcoin through a new lens. A lens crafted by one of their own. This analysis is a permission slip for a generation of conservative fund managers to finally enter the market. And the final takeaway for everyone watching is this. The landscape has been permanently altered. The arguments of the past are now obsolete. The institutional validation many thought was impossible is now happening. The race to reprice Bitcoin against gold has been sanctioned. The race is on, and the destination is clear. If you found this analysis valuable, make sure to like and subscribe to stay informed as this story unfolds. The multi-trillion-dollar pivot is here. Thank you for watching. We'll see you in the next analysis.